Okay, good morning, everyone, and welcome to our third results webinar of the season. I'm delighted to say we've got another five companies joining us this morning, and we had another five joining us this day last week, and we indeed had five others yesterday morning. You're all very welcome to this morning's session. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who is joining us for the first time, and for all our regular attendees, you're very welcome back. I'm just going to quickly run through these intro slides and then we're going to get straight into it with our first presenter. I would like to make a special mention of VRS Research as a Service, who are our sponsors for all our online events here at Coffee Microcaps. If you are looking for some institutional grade research on some small and microcap names not kind of covered by the brokers, please do check out their website. And as always, very special welcome to ASIC this morning. For anybody who is joining us for the first time, the companies we have had on over the last 5 years here are capped under 300 million in revenue and approaching cash flow break even, or as we'll see from some of our companies this morning, are indeed already profitable. We tend not to have companies from the resources and biotech sectors, what I like to call industrial microcaps, but that encompasses everything else from healthcare, financial services, professional services, hardcore industrial companies, kind of a catch-all of everything outside of resources and biotech. Structured this morning's webinar, as I said, we've got five companies presenting, each going to get 30 minutes as our standard, 20 minutes for Prezzo and 10 minutes for Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It does just make it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Tuesday of next week. Yesterday's event will be going live on Monday next week. You can get us on pretty much all the socials. Twitter's our main one. YouTube, as I said, for recordings of this webinar and indeed the other two in this results series. LinkedIn and my free monthly newsletter will be going out middle of next week as well, which you can get on the Substack newsletter platform. I'm delighted to have Joseph Oliver from Delorean Corporation up first. After that, we're going to welcome Melinda Sheppard. Should be no stranger to regular attendees here from Pureprofile. Then we're going to have an update from Stuart and Sujata Steed from Janison Education, who are coming back in to give us an update. Been a while since we've heard from the Janison team. Michael Shirley is going to be joining us from Veris once again to give us an update. And finally, we'll finish off down in Melbourne with Stephen Lydeamore. Again, shouldn't be a stranger to anybody on here regularly, who's going to give us an update on all things Immuron. So with that, I'm going to stop sharing my screen and hand you over to Joseph. Joseph, you want to just pull up your deck? I'll let you know once it's... Yep, I can see the cover slide now, Joseph. You can take it away whenever you're ready.
Many thanks, Mark, and good morning, everyone. I'm Joseph Oliver. I'm the Managing Director and co-founder of Delorean Corporation. So I'm going to just step through a few slides today, probably about 15, 20 minutes of an investor update and just some of the progress that we've been making across this sector that we're leading and pioneering. So a little bit about Delorean Corporation. We're a 12-year-old business. We listed 4 years ago on the back of profit. We've built 4 out of the 6 anaerobic digestion facilities which process organic waste that is diverted from landfill into energy in the form of biogas that we're able to utilize as a form of energy in terms of biomethane, natural gas equivalent, or electricity. So we've built 4 projects, all of them. The one that you can see on the screen is our final project for Yarra Valley Water. Before we go into the transition of build, own, operate as well. So our engineering division has got the building capability, built the award-winning facilities that have all met nameplate and exceeded. Our infrastructure division is our focus around a build, own, operate pipeline that we've developed over the past few years. And our energy retail division maintains its retail licenses and has been trading LGCs, which we'll discuss as well. So just a quick investment highlights, and I guess to really put it in perspective, we're changing from a third-party construction business into a build, own, operate with a high focus on annuity-based revenues, infrastructure ownership, and driving change across the nation as we roll out a national footprint of organic processing facilities that generate energy that can all be monetized. We see this as a long-term value upside because we're able to capture long-term commitments in the form of attractive ESG green benefits from an offtake perspective that we're able to decarbonize that hard-to-abate sector that is currently struggling outside of the electricity side with the focus on green gas. And we feel that we've got really attractive dynamics with the strong growth potential leading this market, but also the pipeline of activity that we've got that I'll step you through. So a couple of achievements to date. Look, yesterday we announced a $6.1 million grant funding that's been awarded by ARENA, which I'll talk on for our SA1 project. But we also secured a 30 mil corporate facility with the Tanara Group to enable us to transition to that build, own, operate that we will refinance out once the asset is built. We've been forming strategic relationships that are well advanced for offtakes. We've applied for over $40 million of grants, which we've secured just over 11 million now. And the pipeline of activity, the capital that we've deployed across that really sets us up for future growth that we'll discuss as well. We're also in active dialogue with the Big Four around debt financing on the back of long-term contracts that we're securing at the same time, which will enable the pipeline of activity so that we can utilize debt funding into a highly leveraged asset that is backed by annuity-based contracts. And we continue with our partnerships with Brickworks and others across the nation. So we'll talk about the Yarra Valley Water Project and a bit more on what we've done around the corporate and investment into human capabilities as well across the business. So a lot of strengths that we've deployed, and we've highly focused on maintaining profit across the business. So we did a 12.3 million revenue for the half year. It generated us a 1.4 mil of adjusted EBITDA and a positive NPAT of just short of $1 million. We had a cash position at the back end of last month of just over $12 million. And we've drawn down $17.8 million of our 30 mil facility that we're converting from debt into asset. So long lead items have been ordered, and we'll step through that as well. Now we've secured the 6.1, that takes our secured grant up to 11.1 of the 40 mil that we've applied for nationally in different states and federal. So just a recap, across over the past 12 years, we've been heavily focused on building the IP in the business, understanding the Australian context, and we've done that through delivering third-party contracts that have been profitable, including the Yarra Valley Water Project that we're in the final stages of completing. Utilising that IP, developing into our build, own, operate pipeline, we've put a lot of seed capital into that to enable a pathway for us to transition into a build, own, operator. So we've completed development approvals, licenses with the EPA across pretty much every state now of Australia. And the successful deployment enables us to have shovel-ready projects, SA1 obviously in build, VIC1 ready to go subject to FID, and then a pipeline that falls behind that to continue to grow the asset base, but also the annuity-based contracts on the byproducts that we've got from those facilities. So as per the announcement yesterday, we secured $6.1 million of grant funding for the SA1 project, which has been put towards the infrastructure of the biomethane upgrade unit. That will enable us to capture the carbon dioxide and look to liquefy it, renewable gas certificates as well, RGGOs, and also capture renewable green gas that we'll be able to put into AGIG's network and secure a long offtake that we're currently in negotiations for. We're in advanced negotiations across those CO2 and biomethane, and we expect to be updating the market in due course, which is what we've got a CP against, but a high level of confidence as well as support from Arena to make the announcement yesterday and secure that $6.1 million of funding. We see these projects as multi-revenue stream projects that enables us to build up the capital stack of revenue with long-term annuity-based, high credit-worthy counterparts that enables us to bring in further financial support, financial backing with top-tier finances. So it's a really strong pathway, including acknowledgement from the government of the work that we're achieving in this sector. So our South Australian One project is based in Edinburgh Parks, just north, 20 minutes north of the CBD in Adelaide. It's a 22,000 square metre site that we own, and we've started the earthworks on site, and we're moving it through a construction program. So our long lead items are ordered. We've been deploying capital into the facility with first waste expected in Q3 of FY26, which will then enable first gas and the construction to be complete before it moves into a long-term O&M, which will be covered by our engineering division. We've secured multiple feedstocks across the region. We've got our Clean Energy Regulator, ACCU methodology signed up, and we've also gone through the green power registration for the RGGO. So ticks a lot of boxes from a ESG, but also an environment perspective of the credits that we're able to generate from the facility. The focus is outputting green gas and CO2, as well as we're doing quite a lot of work in the digestate space where we're able to capture those nutrients and output to a corporate farming model as well. So a lot of benefits from the byproducts that build up a really strong revenue stream against each project that we've got. So that's SA1 in focus. In addition, we've got VIC1, which is shovel ready, which we're just in the final stages of reaching that FID and securing some further bank finance for that to support that moving into construction. The Brickworks project, the New South Wales one, is moving through a process of development approval, and we expect that to come out and move into FID by the end of this financial year. In addition, we secured $5 million for the Queensland project that is moving through a development process that we'll put in place probably by the back end of this calendar year and move that through into construction as well. Across our engineering division, we've been building the team, but we've been successfully delivering projects for the past 12 years, in addition to the Yarra Valley Water project, which is a $53 million third-party contract that will move into an O&M contract in the coming months. We expect to be processing waste back end of May, moving into O&M in the June timeframe. We'll be producing gas that will enable the generators to run, and that site will be moving into a full operational maintenance. The facility is a great credit to the team. We've had over 40,000 man hours on site without any incidents, any lost time incidents, and we're maintaining our ISO quality and safety audits, which is a great achievement across this heavy civil work into the structure and into the completion of the facility. This facility is a 55,000 ton facility that will generate about 39 megawatts per day, which is supporting the Yarra Valley Water decarbonise their business. So just a quick recap on the projects that we've built over the years. All of these facilities have been running at nameplate capacity and above. That enables us to meet our practical completion, enables us to really take great credit in the work that the team's completed. The Jandakot facility with Rich Grow Garden Products has been operating since 2015, so over 10 years now, and is processing commercial and industrial organic waste. So that's everything that comes from the food waste market, plate scrapings and other organics that is being diverted from landfill. The Blue Lake Milling facility is processing ag residue, so fairly clean ground oat husk that we're able to process to generate energy that's supplying power and heat behind the meter to Blue Lake Milling in South Australia. And the EcoGas project is processing organic waste from municipal, from the Auckland region of food waste, as well as commercial and industrial food waste there as well. So each facility has processed an array of different contaminated or clean organic waste streams to produce energy in the form of biogas that we're able to upgrade to biomethane or to electricity to put into the grid and offset from a green perspective. Across our energy retail division, we successfully deployed an LGC shortfall strategy that has brought an additional $1.9 million into the business. And under that is now complete. And we're maintaining our energy retail licenses nationally, as in addition to we've got our Victorian gas license. And whilst we build our infrastructure across our project pipeline, our focus will be leveraging our retail licenses to enable the highest price that we can achieve in the market on a long-term offtake perspective, supported by our retail division. So where are we heading? Look, for us as a business, as we transition into infrastructure, we strongly stand behind and the board's objective of achieving an enterprise value of 300 million by FY 2028. And that's based on our project pipeline that we've got and the activity that we've got there that really enables the rollout of our national rollout of our high yielding infrastructure assets that are backed by long-term annuity-based revenue streams that is supported by our EPC division, engineering division, that enables the build of those assets in addition to the operation and maintenance moving forward. So we're heavily focused on supporting our client base to achieve net zero targets in the large industrial, hard to abate sectors that are heavily focused on decarbonisation. In terms of what does this half look like, there's a lot of work that we're moving through across the different divisions with now with the 6.1 million announced, we'll be closing out the contracts from a CO2 and a biomethane perspective over the coming months. We'll be looking to move Vic1 and New South Wales 1 into construction. We'll be ensuring that we successfully deliver the SA1 project on time and budget. And we'll continue to form strategic relationships across the sector to support the growth and align to a net zero perspective. Across our engineering division, we'll be heavily focused on completing the Yarra Valley Water project, moving that into operation and maintenance, and supporting our other projects as we do from a technical perspective in addition to that. We're maintaining a high level of operational excellence and risk management across the business. It's great to see that we haven't had any incidents in the Yarra Valley Water, over 40,000 man hours on site constructing that facility, and we are heavily supporting our industry partners to achieve their ESG targets and decarbonise their business in the hard to abate sector. So I'd like to thank everyone for your time and interest in Delorean, and happy to answer questions, Mark.
Cheers, thanks, Joseph. I might just kick off the questions here. Um, Government regulation in your space, is there anything happening at a state or national level, that if we look down the pipeline over the 5 years of like building out this kind of national thing, is there kind of anything there that is in place or you're expecting to come into place, over the next while that's, going to make this energy offering, more attractive to partners, state governments, local governments.
Yeah, there's quite a bit actually over the next few years from a policy change perspective. So this year we're seeing large industrials have to report their Scope 1 emissions. So that's got to be out into the public. There's a big focus on decarbonising that, offsetting that Scope 1 emission. We can support that with our facilities and the energy offtake agreement. So that's a big tick in that side. There's a lot of policy change and further support looking to be implemented around producing green gas, which is where our focus is, mainly because from an electrical perspective, solar and wind enables the generation assets or green electricity, whereas green gas, there's only one facility producing green gas. And as we know, hydrogen is currently out of the money from a commercial perspective. So our client base in the large industrial sector is heavily focused on decarbonisation. They've got emissions reporting coming, and the alternative to natural gas, hydrogen, is too expensive for them. So a lot of change. We're also supporting policy change. We'd like to see further organics being diverted from landfill. There's a mandate to halve that by 2030 currently, and we are starting to see with the food organics and green organics or garden organics starting to enable further capture of organics for our facilities as well. So a lot of change, a lot of movements in the right direction for us compared to the past 12 years. So it's I think we feel the timing's right now.
Yeah. I've got a question here, but the one from the audience is pretty much asking the same thing, but mine maybe might be a little bit more detailed. In terms of, all of these projects, you've got in train and historical ones, kind of what's the and size of projects, what's kind of the sweet spot, that of things you're looking at in terms of, okay, how long it takes to build this, capital we need to deploy, and, what would be like a target IRR or whatever, whether it's an IRR or payback period, maybe give us just an idea of, as you expand the presence nationally, what is a kind of a standard or ideal scale uh, model that you're kind of working to?
Yeah, so the South Australian One project is a great example of that. Typically that capex is about $30 million, with additional bolt-ons probably about $35 million. We're able to achieve IRRs of north of 15%, and into the 20% when we start looking at the digestate, the liquefied CO2, and other elements that really support that. Our typical size at around 70,000 tons, we feel that is really economic, and from a location perspective, easy to move through a development approval process, but also easy to construct as well. So from a land perspective, and waste in the area, is probably 50 kilometers as opposed to 200 kilometers from a radius perspective of the facility. So we see this as more of a national rollout, supported by long-term offtakes, enables a higher leverage and no overhang from the market, in addition to the grants that we've applied for from a support perspective that's seen as equity, and more of an infrastructure rollout, so a portfolio of approach, as opposed to trying to build one big facility in each state. This is more of a we're looking to build 10, 20, 50, 100 plus facilities over the coming years.
Got another question from the audience here, Joseph, in terms of, is wastewater recovery treating to Class A water specification utilized to reuse water in your process or sold to external industry? So you were talking about, the CO2 is another revenue stream on top of that. Is wastewater another potential revenue stream on top of a project?
It is. We're doing a lot of work into that. We have within Delorean, we've got our own lab. We've got process engineers that are working on that side. And what we're looking to do is actually get it to a Class B standard. We can output into a purple scheme that we can get paid for on the water side. But we're mainly looking at recovery of the nutrients, probably adding a few other nutrients and then selling that as a product out into the marketplace that will give us a further upside to that sort of 20% IRR that we spoke about earlier. So there's lots more opportunities as we optimize our facilities through the operation phase of after completion of construction.
And then can I maybe just touch on the grants? Because you said, you've kind of got 11-ish million now out of the 40 you've applied. The remaining that you've applied for, is that linked to specific projects? So, as you progress down the construction phase, that becomes into it? Or is it just more, it's coming from federal government and it's for kind of the rollout of this strategy more broadly and not really linked to a particular project in Queensland or New South Wales?
Yeah, I mean, I can't talk about the details, but they're all the grants that have been applied are second stage. So it's moved through the first stage. It's linked to a project or projects, and it's an enabling piece of that. It probably, at times does hold us back from an FID perspective, but we're heavily focused on that support where the support is needed to ensure that we can move these projects into construction and support on the de-risking part of the project as well.
Yeah. And in terms of the long-term offtake agreements, you mentioned, you're in negotiations with, is that with industrial users kind of in the vicinity of like where your projects are, or is it, supplying it into the big energy generators and retailers as an adjunct supply to, their operations?
Yeah, good question. We're heavily advanced in that space. It is more about supporting industry, and we're heavily focused on supporting that industry move forward and decarbonize, as opposed to sort of moving through a retail path. We do have our retail licenses as I highlighted, that enables that support there as well.
Okay. How are we doing time-wise? Yeah, we can squeeze in another one. Brickworks shouldn't be any surprise to anybody who's been on here. I've had a couple of chats to Lindsay Partridge down through the years on various different platforms and various different things. They have gone through a big investment cycle, but maybe just give us a little bit of history of, how that corporate partnership came about, and is it a model that can be, you're kind of looking to replicate with, it mightn't necessarily be brick manufacturers, but industry more broadly.
Yeah, look, not to dive too much into the brickworks side of things, we've got a great relationship with Brickworks. We have done over the past sort of 4 or 5 years. We're supporting Brickworks and others decarbonize in that space that is the hard to abate, and bioenergy, which isn't core business for those, really enables us to focus on what we're achieving basically. So long formed relationship with the experts in this space. We've developed multiple projects. We're supporting and leading the development of that project. We've got a section of land where we've highlighted for the development approval, and that will move into construction by the end of this financial year. So yeah, great relationship, more focused on energy offtake. So again, they're wanting to secure energy behind the meter for a long-term offtake in this current sort of potential gas shortage that has been spoken about in the media recently. So this is enabling us to utilize, us as a microcap, Brickworks as a $4 billion business. It shows a strength of relationship and acknowledgement of the team that we've got at Delorean that's delivering key objectives for such a large company like Brickworks and others.
Okay. Joseph, we're kind of just up on time there, or at least not enough time to squeeze in another question. But thank you very much for joining us this morning. I know you've had a busy week presenting at another conference yesterday, and you're flying back to WA today. So thanks for squeezing us in here this morning. And yeah, hopefully we can get you in maybe in the back half of 2025 when SA1 is up and running, and yeah, a few more projects are a bit further down the line, and maybe a few more grants have come in.
Yeah, it sounds good, Mark. And look, really appreciate everyone's support and interest in what we're doing as we pioneer and drive this sector forward. So thank you for your interest.
Thanks, Joseph. And we will now hand over to Melinda Sheppard from Pureprofile. Melinda, morning.
Good morning, Mark. How are you?
Good. Melinda, if you want to start sharing your deck, I'll let you know once it comes through here.
Okay. To share my screen. Share. Sorry,
Yeah,
I'm just
just loading now, Melinda.
And then
yeah, so I go to present mode. It should go into the full screen. Yeah. Oh, hold on.
Okie dokie.
Okay.
Great. Well, welcome everyone. Sorry, I didn't know if you want to introduce me first or
Melinda Sheppard, CFO of Pureprofile, joining us again. Martin Phils unfortunately can't join us this morning, but I think anybody who's been on any of these calls before and or knows the Pureprofile story should know we've got a very able deputy in his place here in Melinda. She's been with the business even pre-Martin's time, so I'm sure she'll be able to take it away with the same enthusiasm as Martin to his presentations.
For anyone that knows Martin, I'll try my best, but we are slightly different temperaments and personalities. But yeah, so thank you for having me. And as Mark said, Martin's unable to make it today, so I have the wonderful opportunity to present to you about our business and actually our fantastic results that we've had for the first half of the year. I'll kick off first just a little bit about us. So I've actually, as Mark said, I've been with the business since 2018. I joined at a pretty pivotal point in the organisation where we had some challenges with the organisation due to some acquisitions the company had made a couple of years earlier. Pureprofile was founded in 2000 and then we listed in 2015, did a couple of acquisitions across 2016 and 2017, and that really put the business in a little bit of a challenged position. So I joined the business in 2018 and set about streamlining the business, looking for opportunities to improve the performance of the organisation. And then Martin joined us in August 2020, and that's really where the business strategy and the business performance accelerated once we had a new CEO on board with really fantastic industry experience. So what do? Well, we're a global data and insights business. So we really help brands, businesses and governments answer questions. So they need to answer questions all the time to make public policy, to decide what sort of advertising campaigns that they want to do. There's all sorts of decisions that businesses make every day, and they need really good quality data to do that. So how do we do that? Well, we connect these organisations, whether they're a brand or a business or a government department, with profiled audiences. So audiences that are the right target audience they need to help answer that question. And we create data and gather data and give those insights back to those organisations. And we do it through our own proprietary technology platform that we've been building since the day that we were founded. And we survey and reward those people for their sharing their opinion. So really important. And we do it because organisations need really good data to make good decisions. You know, you can't always make decisions without fantastic data to help you do that. So we operate in 12 countries. We have 14 offices. The global expansion has really occurred since 2020 when we put in place our global strategy. We've got about 827 clients globally, and that continues to grow each year. About 242 staff. Now that's across all the different regions here. Predominantly, most of our staff are outside of Australia. Australia is our head office, and we have a number of sales people in Australia, but outside, you know, the bulk of what happens in our business occurs outside of Australia. We had a fantastic first half result of $29.2 million worth of revenue. And what's really important about the next number of being $13.2 million in annuity revenue, that's really sticky revenue for us. So that encompasses license fee revenue that we get from selling our platform products, but it's also long-term studies that our clients do with us. So that might be things such as NPS studies or brand awareness studies that they'll do over a period of time. So they can go anywhere from 12 months to 5 years, and they're kind of the holy grail of revenue within our industry. So we work really hard to try and win that business, and then we work really hard to maintain that business because it, you know, obviously helps us lock in a good portion of our revenue for the year before we go into it. And then most importantly, we delivered $1.6 million worth of NPAT in the first half of this year, and that was compared to $40,000 in the same period last year. So a significant uplift in performance in the first half of this year, and that's really a testament to the global strategy that we've been executing since 2020. So what is that corporate global strategy? Well, the key thing is replicating what we've been doing in Australia. So Australian and New Zealand business are our really mature businesses. We're a market leader in Australia. In New Zealand, we've got a really good market share and footprint there as well. And we wanted to replicate that success outside of Australia. And I'll talk a little bit of why that's so important and coming up in some slides. So what we do well in Australia, we made sure that we could replicate that in other countries. So we have a bit of a operating model that we, when we go into a new region, we focus on executing on that operating model, and that's why we've been so successful growing outside of Australia. So we make sure that we've got the same processes and systems in place so that our clients have seamless experiences in all regions that we operate in. The next thing is what's been really important part of that strategy is really around our technology. So looking at what we're building, the client-facing solutions that we have, internal efficiency solutions that we implement throughout the business, really important to make sure that that experience for clients is seamless. We use technology to make things faster and quicker. And then we also have been building out our platform solutions as well that our clients utilize. And you'll notice when we go through the financial slides how that platform revenue has consistently grown over the last 4 years as well. And that's testament to all the work that our tech teams have been doing around a number of the products, such as the audience builder solution and the insights builder solutions, etc. And then the final piece is just making sure that we're leveraging the data that we are collecting and analysing across all our different solutions. So data and insights, our audience builder solution, our audience intelligence solution, and our insights builder solution. We will be coming into the new financial year talking about some of our new solutions that we're about to roll out. They're all in final sort of phase at the moment, growth phase, and we'll be doing some soft launches towards the end of Q4 this year. And those solutions also allow us to utilise our data across those as well. And they're a really important part of leveraging technology for our clients as well. So what's the opportunity here? And look, the market research industry is a very large industry, as you can imagine, when you think about how important it is for businesses. When we think about Australia, and as I said, we're number one leader in Australia, the opportunity really for us has always been outside of Australia. You know, if you listen to Martin talk before, he's an industry veteran, and he'll tell you that he's never worked anywhere where the Australian business is much larger than the overseas business. And so we've been really focused on taking advantage of the much larger total addressable market outside of Australia. So when we think about it, like the UK is 5 times bigger market than Australia, and we have really tiny market share there. So there's a really great opportunity for us to leverage our size being small and take market share from our competitors. And then when we think about the US market, that's 30 times bigger as well. So there is a vast opportunity for us outside of Australia, and that's why our corporate strategy has really been focused on those regions. And, as I said, the success of our results really is a testament to going into those regions, successfully executing on that strategy and replicating what we do really well in Australia in those regions. The next opportunity, like I think a lot of industries have, it's a headwind and a tailwind in many respects, is really artificial intelligence. We've always used machine learning and AI within our business, but there's more opportunities, obviously, with a lot of the new technology coming out and solutions for us to utilize AI, predominantly for a lot of different reasons in our organisation. We've done a lot in FY24. We did a lot around building our internal efficiency. So using these AI solutions more so for internal operations. So we have a large operations team in India and a smaller one in the Philippines. And what we've been using AI for is to help those teams provide greater service, quicker service to our clients. And then also some of these solutions that we built, such as translations, we were using an external translations agency to help us with that. We can now do it internally, and that obviously improves our margin over time as well. We're putting out a number of client-facing solutions. That's always been part of this stage of this corporate strategy. We're building out a client-facing solution called the Hub, which will be the sort of the window for all our clients to enter Pureprofile and access all their products and services. We've also implemented audio and video surveys using AI. If many of you have watched some of the presentations before, Martin may have spoken about that. That's where we have AI doing video surveys with panelists, which has been really well taken up by our clients. They love it. It's a fantastic new innovation that we've rolled out. And then we've got a lot of pipeline of other products, as I said, that we'll be looking at soft launching at the end of Q4, and we're expecting to start to see the take up of that during FY26. And then the final piece of that puzzle also is really AI companies being our clients. So, AI companies will continue to need vast amounts of data to feed their large language learning models. So we are setting ourselves up so that we can be a beneficiary to help them do that with our technology and obviously our large audiences. So that's a new opportunity for us. It's something that we're focused on at the moment, and you'll hear more about that over time. I won't go over this slide too much, but we've been on a bit of a journey. As I said, Martin came in the middle of, at the very start of FY21, and that's where we did the company restructure, put the company in a really good position to really accelerate and take off from that perspective. We had a much stronger balance sheet, smaller debt, and Martin also refreshed the executive team, which really set us up for success over the next couple of years. Then we spent a couple of years really investing in the business, in people, so making sure that we continue to build a fantastic team, building out our panels in lots of other regions outside of Australia, and really focusing on building our tech. So fixing up all our technical debt and starting to build lots of new solutions as well. So it's been a really important part of getting us to where we are now. And then we're in the next stage of that corporate strategy where we're really focused on driving growth further and really improving our margins. And that's really what you've seen over the half one results, is the strong top line growth and that improvement in the margin over the last 6 months. And a lot of that's come from the improvement in margins, really has come from a lot of the heavy lifting that was done over FY22 to FY24. So we're obviously past halfway into the financial year. Again, the strategy is driving growth and improving margins over time. If I think about driving growth, it's making sure that we can expand the client share of wallet. So not only are we focused on seeking new clients, we also want to make sure that we're getting every single dollar we can from our existing client base. And that's actually been a huge part of our success over the last couple of years as well. If we provide a really fantastic, high quality service to our clients, they're going to continue to work with us. We're focused on increasing the number of products and solutions. As I said, we've got some new solutions coming out at the moment. That continued target investment in the UK has been incredibly important for our strategy. We've hired a number of new senior sales individuals in the UK. They've sort of slowly come in through this financial year, and that will help to continue to set us up for the rest of 25, but also going into 26 and 27. And then we're heavily focused on exploring partnerships in the UK and the USA. We've got some great partnerships in Australia. We want to replicate those outside of Australia. The other important thing is really trying to create better operating leverage for the organisation as well. So really shifting our split of revenue to be more platform focused, so tech-enabled revenue, where we don't need as many headcount resources to enable that revenue to occur. Our managed service business is incredibly important. So we will continue to focus on that, make sure we're maximising that, but we will be shifting more to tech-enabled market research solutions. We want to make our client solutions automated again to make us more efficient, make it easier and seamless for clients, remove the friction that's there. We want to use AI to improve our internal operations, and we can continue to streamline our ways of working. And I think that's a really important thing, is the continuous improvement in the way that we do things to make our business better over time. So as I said, focusing on new clients, so new commercial people typically will bring in new clients as well. Focusing on the corporate commercial partnerships, really important for us. We've been through technology and AI, all the different solutions that we're looking to utilise within our business, internal, external, and then continuing to build and to find new audience builder partnerships similar to our flybys, our rays, our news partnerships. They're really important to help us grow our audiences outside of Australia. And then just again focusing on the big markets. The UK market is the predominant one that we're focused on at the moment. We are growing our US business quite strongly at the moment, but we're doing that with no boots on the ground at this point in time. And over time, we will be looking to put a greater investment into that market. And then just again, the aspirational objectives for FY26 and 27, and we're not far off going into 26 now, is again focusing on those two pillars of driving growth and improving margins. We think we're very close to seeing the international revenue overtaking ANZ. That said, the ANZ business has had an incredibly strong year this year. I think they're so competitive, they don't want to see the UK business double and be much stronger than the Australian business. And so a little bit of healthy competition within our organisation is not a bad thing. Expanding the product suite. We are always looking for small-ish acquisitions, things that can help us accelerate in the markets outside of Australia. Looking for economies of scale, again, making sure that we can get that operational leverage. We're heavily focused on a lot of those key metrics over revenue. Making sure that we can do really fantastic procurement deals when we have to buy third-party panel. So making sure that we're getting the best prices we can, consolidating suppliers. And then a new one that many of you are following Martin on LinkedIn, talked about is we've launched a synthetic data solution yesterday, actually, which is something that's new for our industry and a real opportunity as well. So we're making sure that not only are we focused on our managed service business, but really looking at all these new opportunities and technologies within our industry. And really being that tech-led organisation as well. And, we restructured our product group in our business and set up a particular hub of innovation to help us to become more of a tech-led organisation with a chief product officer leading that strategy. So that's been a really important thing for us as well. Now, just onto the financial aspects. So, as I said, an amazing first half of the year. We were so pleased with the results. We delivered $29.2 million worth of revenue, which was 22% up, and EBITDA was $3.3 million, which was 38% up. We had an improvement in margin, and importantly, a really strong net profit after tax result. When you look at the business units, what's really standing out here is the ANZ business grew 16%. For those of you that have been following us in the last 12 months, the ANZ business had a bit more of a challenging year throughout FY24. So we had to put a number of strategies in place around pricing to really bolster that revenue in that region, and we've really seen the success of that come back now. The ANZ revenue also is a function of the iLink acquisition that we made that completed on the 1st of July this financial year. So that's also contributed to that uplift. And then the rest of the world revenue at 30% growth is really consistent with what you've seen before. The only other things that I point out with the half one result, we are obviously being a global business. We have a lot of revenue that we generate in other currencies outside of the Australian dollar, including the US dollar and the pound and Singapore dollars. We know that the Aussie dollar has weakened significantly against those currencies, and that we've been a key beneficiary of that. So another fantastic thing for the global strategy. We did have just under $500,000 net foreign exchange gain during the year related to that. But we also have a couple of little one-offs that were related of expenses that were sort of netted off some of that, including a bad debt expense for 2 clients of just under $200,000, and then a small amount of additional costs related to the auditing of the iLink acquisition. So overall, really happy with the result for the first half of the year. And again, just here you can see the consistent results that we've had over the last 4 years now, and the strong growth over that period. So relatively consistent. If you look at, half one, we said the ANZ region had 16% growth. Now it's been 17% over the last 4 years. The rest of the world, 40% growth. So that's consistent. Your platform revenue, 98%. And that's been where we've had a lot of growth around those audience builder solutions and other technology solutions we run out. And then also the strong EBITDA uplift as we really start to now get some traction from an operating leverage perspective. Just quickly, over the last couple of years, we've significantly focused on not only growing the top line, but really growing the bottom line. We know how important that is. Our shareholders have been very clear to us. They've wanted to see us become cash flow positive, which we have done over the last, we've been operating cash flow positive for a while, and we're now cash flow positive. But also growing the NPAT results. So you can see here going back 5 years to FY21, the first half, a loss of 3.7 million versus a gain of 1.6. So that's really a function of the focus on the top line, but also the focus on improving margins over time. So that's a fantastic result from us. And then just a quick stat profit reconciliation. We've gone through the EBITDA result. Financing costs pretty much in line. Don't really have any restructuring or acquisition costs this year. Amortization expense is about the same. We have had a drop in share-based payment expense over the last couple of years. That's significantly gone down. There is a couple of plans still flowing through that were 3-year plans that vested over 3 years. So that's why that's come down. And then we had a slight income tax credit this year as well. And that sort of brings you back to where we are, the profit for the year. Balance sheet's looking really strong. We had a really good cash balance ending at the 31st of December, and that was a good result. If you factor in the first initial payment for the iLink acquisition, which was $625,000, we've also, in addition to paying the interest on the principal of our debt facility, we've repaid $100,000 of the principal. And if I look at all the other aspects on the balance sheet, the increase in the intangibles on the balance sheet is really the assets that were acquired from the iLink acquisition. And that's kind of really it, the highlight. Everything else has sort of grown in as we've obviously grown the top line, the trade receivables will increase. The trade and other payables also includes the final payment of the iLink acquisition, so that's why that one's jumped up a little bit as well. CapEx expenditure is kind of broadly in line with what we've done over the last 5 years. We don't have any intention of doing a significant uplift in our expenditure on CapEx. So this is predominantly our product and technology teams, where they're building different solutions. A lot of what they've done in the first half of this year relate to some of the solutions we talked about earlier. The client-facing hub solution, which is the specialised applications for partners and really their window into Pureprofile. We've done a lot of API integrations and optimizations. They're really important because that makes our business much more efficient, more streamlined. It removes the requirement for people to do a lot of manual work and doing a lot of platform enhancements and new audience builder integration. So I'd expect to continue to see the CapEx to be the same over the coming years. And you can see, obviously, the amortization expenses has continued to come down. That will start to flatten out more as the expenditure level has really leveled out. Cash flow, as I said, it was a really strong result, really pleased with the cash generation during the half. And as I said, key fundamental differences was really the iLink acquisition first payment and then the debt facility that we're making every quarter as well. We upgraded our financial guidance for the full year on the 28th of January. We've narrowed the range. Obviously, after having a really strong first half result, it made sense to communicate to the market that we expected the full year result to be better. So we've narrowed the range from 57 to $58 million. Previously, the range was 55 to 57 million. And then rather than giving an EBITDA margin guidance, we've given the dollar value. So we believe it'll be somewhere between 5.2 and 5.8 million. And that was previously 5 million to 5.7 million based on the previous guidance. So that's where we feel that we're going to land now once we finish Q3, and we'll be putting out our Q3 results towards the very end of April. We will either reiterate the guidance or make an update to it as we do in other periods. So key summary of all of that, really strong result in half one, really proud of delivering such a strong profit result. Had a strong revenue result for the half as well. Great cash balance, really happy with that. Even after funding the iLink acquisition, upgraded our guidance. And really importantly, this final one is really this new product innovation team that I mentioned earlier. That's been a really important part of our strategy, is to really make sure that we're leveraging all the technology that is out there within our industry, using AI to drive efficiency. We've got to continue to do that and look for every opportunity we can to be innovative and to really help organisations with the data, decision making off great data. So that's really the summary of Pureprofile.
Thanks, Melinda. Yeah, questions have been flying in here, and hopefully we've got hopefully we've got enough time to get through them all. But the Janison team are running a slight bit late. They just emailed me, so hopefully we can get through them. We're just waiting for them to join. Talking about the product innovation team, let's tackle this one first because it leads on nicely. Can you give us an update on the recent launch of the video interview with avatars? What's the take up like been? Does it give you higher margins? You talked a lot about like AI and trying to, get more tech in there as opposed to people. And the video offering is that, unique in the industry and something Pureprofile offers that, others don't, kind of set you apart?
Yeah, that's a great question. Look, it is a really great solution. We are going to be looking at doing a product and client and investor day in June, and we'll be demonstrating that solution on that day, which we'll be communicating shortly. It'll be an online sort of investor client day for everyone to join, and they can live stream that if they wish, and we'll show those products and solutions there. We definitely have had a lot of interest from clients with regarding that. It's obviously it was a very new solution within our industry, with the avatars and the way that. So I think the reason that clients love that solution is when you give someone a survey, and they have to type in a result when you ask them a question, they're less likely to have a lot of extra verbatim in there. So when someone's talking, and actually, particularly a lot of the younger generation, they do a lot of things verbally, right? So they'll put messages on their phone verbally, they like their Snapchat. So what we're finding is that the surveys that are conducted by video seem to capture a lot more information. And so what we do with that AI tool within there also is it transcribes and codes that survey, puts it into categories, and gives the clients a greater set of data and insights than they may well have otherwise. So there seems to be quite an interest, particularly in specific types of surveys. I know that we've done a non-political research video survey recently, just asking panelists how they feel about what's going well in the economy, what's not going well in the economy, etc. And I know that there was a lot of really interesting insights that came out of that. So yeah, there seems to be great momentum and positivity from our customers. It's obviously a new thing. I don't believe anyone else is doing anything like that at this point in time. So I think it's been an interesting, case study for us of leveraging technology to do something slightly different for the industry.
And question around acquisitions. The US, an obvious market to enter through an acquisition, but are there other lucrative markets which you can enter organically, such as, the Nordics or other parts of Europe? So maybe just talk more broadly on,
Yeah.
acquisitions to get you into specific geographic
Yeah.
markets as opposed to doing the US model as you have for the current state of play where it's, doing it remotely.
Yeah. So on the first one, look, we'd love to find a great acquisition that will help us accelerate in the UK as well as the US. The US is obviously a really, really important large market for us. So that would be amazing as well. But the UK is obviously another market that we could look to doing something like that in, even potentially the Southeast Asian market. We've got a small business in Southeast Asia. Southeast Asia is obviously a growing market. If you sort of step outside of Singapore, Indonesia in particular, is a really large market there, growing market as well. So there are opportunities outside of Australia in lots of different markets that we could consider at that point in time. But our main focus really is the UK and the US from that perspective. As far as other regions go, we are already in Europe. So we have a team in the Netherlands of about 4 people. We've also got someone in Germany and someone in Portugal. So we feel like we've got the right concentration in that market at the moment. The European market actually hasn't been as strong over the last 12 months. I think, it's a bit sort of a recessionary impact there. So it's been a little bit of a more difficult market. That said, the team there are doing incredibly well at the moment. They have a really good pipeline going into the second half of the year. But we're not looking at investing new headcount in Europe at this point in time. We'll continue to invest in the UK market in particular because we really see a good opportunity, and there's some really great talent that you can hire in the UK as well.
Okay. I see the team from Janison have joined us now. So, Melinda, we'll leave it there, and I'm going to apologize to anybody's question I didn't get to, but please feel free to reach out to Melinda or Martin. I'm sure they'll get back to you with answers that we didn't manage to get to this morning.
Great.
There we go.
Thanks for having me, Mark. See you later.
See you, Melinda. And we're going to hand over to Sujata Steed and Stuart Halls. Give us an update on all things Janison. It's been a while since we've had Janison on here, so I'm looking forward to this one. So, Stuart, your presentation is just loading now. Yeah, I can see the cover slide now, so you can take it away when you guys are ready.
Thank you very much, Mark.
Thank you, Mark. And I'll just kick off and I'll hand over to Stuart. So I don't think I've been at one of these sessions before, Mark. My name is Sujata Stead. I am the relatively new CEO of Janison Education Group, having joined the business in May last year. And very much the focus for the last 9 months has been on kind of how do we actually kind of refresh Janison's strategy and kickstart its next round of growth and transformation. So very much our focus has been how do we ensure that what the organization is now very well known for, what our key competitive advantage is, which is providing the digital platform for delivery of assessments, large complex assessments and assessments of all kinds, that we bring the focus in the organization back to that, which is our core competency, and where we have a huge amount of credentials and track record. Whether you look at NAPLAN delivering about 4.4 million assessments over a 2 weeks period, often, nearly close to 500,000 exams concurrent. I mean, that's a huge, kind of ability that few organizations in the world can do as far as digital delivery of assessments are concerned. So the focus has been how do we make sure that we ensure that we continue providing, incredible service to our existing customers, but on the back of that, those track records and credentials, we also replicate those successes, especially given that now the digitization of assessments with the K-12 professional accreditation and other sectors is a key discussion across organizations across the world where Janison can add value. And the slides out here are from our first half FY25 results. And I know they say unaudited here, but our audited results is pretty much exactly the same. And just, Stuart, moving to our highlight slide. In terms of our highlight slide, I think what we are very pleased to present is that the first half, we've had very solid financial results, especially given that FY25 is a year of transformation, is a year we're ensuring that we are actually kind of rebuilding our capabilities, our pipeline in terms of customer opportunities and heavily investing in innovation. But we're doing all of that in a manner that the business continues to grow. So looking at 3% top line growth, but if you look at underlying growth, like for the platform side, the business is nearly 18%. And we are also very pleased that we are being able to make all of this investment in growth capability and strategy by actually a disciplined cost management and reinvestment of savings. And really pleased that our customer pipeline is significantly strengthened, nearly over 280% strengthening of the pipeline, acknowledging it started from a low base. Our AI platform is now operational. We are using it internally now in terms of developing items for tests that Janison runs. We are also on the verge of signing our first new customer. And of course, as we're doing all of that, navigating through this exciting period of change and transformation, we are doing it in a manner that we are also maintaining very strong fiscal discipline in terms of cash flow and balance sheet. Stuart, do you want to add anything else to that?
Maybe when we go to the next the P&L slides, I'll talk a bit more in detail. But yeah, otherwise, I think a really good result. Good way to summarize it. It's been a huge amount of work's gone on over the past 12 to 18 months. A lot of transition, a lot of change, but I think a really strong result and finishing with a good cash as well. So setting ourselves up for a really good second half, which I'll talk a bit more about in a minute, and beyond that as well.
And in the next slide, what I just want to share, I think, Mark, with you and all attendees is here is just Janison at a glance. I know as an organization, we've been around for nearly 20 years, first listed in the ASX in 2017. And now we are on this exciting journey of growth and transformation as a world. There's more and more demand and need for digitization of assessments. But this slide provides a very strong visual representation that we are actually growing from a very strong foundation. So if you look at high customer satisfaction, the average tenure of our platform clients is about 5 years. Then if you look at number of assessments we deliver assessments in over 110 countries. And similarly, I think 10 million assessments delivered globally, 110 countries, 169 staff, 5 years. So it's a really strong foundation that we are building our business on. And so the whole idea is that we've had exceptional experience and success with customers in Australia. How do we actually now broaden that experience across other jurisdictions in Australia and internationally as well? And some of the focus areas for us is, Asia Pacific, including Australia and New Zealand, but also UK and the surrounding countries as well. Thank you, Stu. I'll hand over to you just to talk about high level on the financials.
Yeah, very quickly, I'll breeze through this, but feel free to put some questions into the chat if anyone's got any specifics. There is one already, which I'll cover on in a minute. But I think the takeout here is, again, as Sujata said, these are unaudited, but they were exactly the same once we'd gone through the audit process and published our annual report, so no change. I think the first thing to take out is the context behind all of this. As I said, lots has happened over the last 6 to 12 months. In particular, in the first half, we actually did a major cost reshaping exercise and we restructured a number of teams. And that allowed us to free up quite a large amount of OPEX and cash for us to reinvest into some very key areas where we believe there'll be good growth, particularly around sales and marketing and product, and also particularly on the platform as well, where we see this large opportunity. What else did we do? We refreshed our strategy. We completely uplifted our operational capability. We invested in and developed some new AI tools as well, which we'll talk about in a moment. Our founder, Wayne, has been very busy developing a phenomenal platform that we've used internally now to develop questions ourselves, which is extremely cost favorable for us, and also presents an opportunity for us to productize and monetize that to our external customers as well. We brought on a couple of new contracts as well. We did see a couple of contracts roll off at the end of FY24, which we'd planned for, but nonetheless, we've seen a sort of net growth in clients there in the first half, and we've been able to manage our cash and costs very well, including that reshaping program that we talked about in the first half. So all of this sort of results in a 3% revenue growth, which on paper is very small, but for us, I think we're pleased about, given the amount of change that we've gone through. And we were able to grow our EBITDA as well, which is a good sign of that sort of headroom we have in cash flow and OPEX to develop and invest in some of the growth options we've got ahead of us. And also we saw an improvement in our NPAT as well. I think if we go just quickly into the two components of our business, or the two business units that we have platform on the left-hand side, which is all of our digital assessment clients. So these are the clients that license our assessment platform. I think sort of Service New South Wales, Department of Education, NAPLAN, all that kind of thing. That was really good, and we saw a 3% growth on the prior first half of the previous year. I think what the key call out on the platform is that underneath this, there's a stronger underlying growth. As I mentioned, there were two contracts that rolled off in FY24. So first half FY24 results you can see here include the revenue from those contracts that finished up last year, and that was quite material. And so if you strip that out and just sort of do a like-for-like comparison, it's more like an 18% growth in platform, which is consistent with what we've seen in previous years. So again, good result there. On the content side of things, I think the key win there is the profitability improvement. For us, we did see a little bit of growth year on year, and we've got some things happening in the second half of this year. We've got a new product launching as a pilot, which we believe could eventually provide some material revenue for us, which we'll talk about in a moment. That's our All Stars ICAS program. But the key call out on content is the improvement in margin. As I mentioned, we through this cost reshaping exercise and through the implementation of AI tools that we've now built, we were able to really strip out a huge amount of cost while still maintaining that high level of quality of our items that we generate for our tests. And the result of that was a 4% lift in GP and an overall sort of improvement in our EBITDA, getting us to 20% as well, which is good and where we believe is sustainable. I'll hand back just briefly now to Sujata to talk about a few of the key sort of other wins.
Thank you, Stuart. I think in terms of the business performance, I think some of the key wins we want to highlight is, I think the first one Stuart has already touched upon, which is, if you exclude CAB and British Council, which were, expected to come off this financial year, I think the whole underlying growth for for this time compared to same time last financial year is 18%. And that does please us, given that it's been a year of huge transformation and change, and that now we are being able to kind of execute on that change and transformation in a manner that the business does not stall or go backwards. Now, in terms of customer wins, I think the whole focus, as we announced the whole digital delivery of opportunity class and selective high school placement tests, the digital delivery, but for New South Wales Department of Education last year. And this year, very much the focus is year one execution, when the first digital delivery of these placement tests will be in May, early part of May this year. So we are on target for that. And we've also secured us kind of a customer in Australian Christian College. Although the value of the contract is small, I think what it demonstrates is that the market engagement and that we're trying to rebuild new customers and new connections in the market. The AI platform is a huge win. So very much the AI platform complements our digital assessment delivery platform, which we call Insights. So the AI platform has very much been delivered where we are first rolling out item development, AI-assisted item development, to create question papers for our exams and for also the exams that our customers are developing. Next phase is going to be marking, AI marking, and then it moves on to AI, item analysis and so on. The beta version of the platform is now operational internally, and we are already using it. So as part of our cost reshaping exercise earlier in the financial year, we actually halved the size of our item development team. And now the existing team is actually, the work is being complemented by AI in terms of the generating questions for our ICAS school competition for 2025 in a manner where our AI platform, which we call JAI, sits as a member of the team with the rest of the AI Janison ICAS item development team. We are ahead of schedule, and we are also producing them in a manner that quality is not being compromised. Some early trials with customers both here and overseas going very well, and we are at the cusp of signing a new customer. So very excited about the achievement. The other one, of course, is, I think this relates to some of the questions that Stella has asked on chat, is about strengthening our customer pipeline. One of the focus here, some of our biggest customers, in terms of, existing customers, of course, you have New South Wales Department of Education, you have NAPLAN. But our focus is very much that how do we actually now focus on building that pipeline where we have a combination of similar projects to NAPLAN and DOE, but there are also other projects for higher education, for government, for professional accreditation. And they have got different periods as far as the conversion happens. And our objective as an organization is to make sure that we have that laser sharp focus on customer engagement and building that opportunity pipeline, though fully acknowledging that in our business, conversion takes some time, but we want to make sure that ultimately we are in the position in the near future where there's, because of the strength of the pipeline and the pipeline constantly being filled with opportunities, that we have got new deals coming, regularly at close intervals, and we move away from the lumpy cash flow that the organization has at this point. And the other, of course, the last fourth point here I want to highlight is the Strategic Partnerships and Advisory Committee. We are a small organization at the bottom of the world, but what we provide in terms of assessment delivery is something actually which adds value to organizations around the world. If you look at what NAPLAN is doing, what Department of Education in New South Wales are doing, they're the forefront of digitization of K-12 education in the world. Other countries and other jurisdictions are looking at similar projects. And how do we actually showcase the incredible work we do here and scale up globally? And that's the reason the partnership and the advisory committee strategy is so important. The advisory committee, we have up to 6 to 7 senior industry leaders across North America, UK, Middle East and North Africa, Asia, Australia, and New Zealand. And generally what they're doing is they're helping us build a brand, build recognition of Janison, and also providing us access to opportunities globally that we may not have. Similarly, also, we are looking at the whole concept of partnership, which is very, very well progressed this year, which is that we exist in an ecosystem as far as learning and assessment is concerned, where we provide the platform and other services, but there are other organizations which offer complementary services. How do we ensure that through partnership, A, we can scale up and be in markets that we normally couldn't be, and B, also through that, we are also providing exceptional customer experience and user experience by taking the strength of our organization and partner organizations together. So essentially, those are the areas where we have progressed, and there's some great wins in terms of growth while transforming, continuing supporting our customers, launching our AI platform, strengthening our customer pipeline, and also using partnership and advisory committee as a way to scale up and build a community of supporters across the world for Janison.
You'd like to touch on a couple of these, maybe AI or...
So Mark, I just want to check with you. Do you want us to continue, or do you want to just stop for some questions? How do you want to take that?
No, let's keep going. Let's maybe get to the end of the deck and then we'll tackle all the questions at the end.
Thank you. And this is some of the key highlights from the content side of the business. As you know, in addition to our platform for delivery of digital assessment, which is Janison Innovation, through M&A, we also acquired a couple of assessments, some exams. And two of those, which are the star performers, is the ICAS school competition and AAS, which is basically scholarship and placement tests. These are exams for the school sector, where ICAS is a school competition where it enables academically, inclined children to kind of celebrate and showcase their excellence in academics. It's very, very similar to what we celebrate a lot in our country, which is sports excellence in sports. But ICAS provides the same opportunity as inter-school competition, but for kids who are more academically inclined. Similarly, AAS is, again, we've been long servicing customers in Australia with AAS, and these are primarily placement tests and scholarship tests for placing students in schools, and huge take-up amongst the private school sector in Australia. Then, of course, the first achievement is, again, going back to the AI tool, where we are now fully operationalize our AI platform to develop contents for the upcoming ICAS 2025 school competition. Then, of course, I think Stu mentioned in his slides that one of the things we've done is also the reshaping of costs. Through the reshaping of costs, I think, and the use of AI, I think we are very pleased to see the improved EBITDA margin for ICAS, which is now 20% for first half of 25. The third one is a really exciting one. That's ICAS All Stars. And this is essentially what we're doing is we run our ICAS competition annually once a year. But the feedback we're receiving from students is that the students who are at the top 10% or top 15% of ICAS achievement, they would love the opportunity to compete with one another at the highest level and showcase their achievements. So very much ICAS All Stars is designed for elite students. We are launching it in second half of this financial year, and the response so far has been really, really kind of overwhelmingly positive. But this year, what we're doing is we're launching ICAS All Stars as a pilot. It's primarily in Melbourne and Sydney. And then based on the learnings from this exercise and customer feedback, we are looking forward to rolling it out as a national all-stars competition for the elite students on an annual basis from next financial year onwards. And of course, I think one of the things we've also done with the content side of our business also is to simplify the portfolio. So the whole kind of objective for Janison is that, our portfolio is actually aligned with what the market needs and the customer opportunities, and also with the resources and capability available in this organization. From that point of view, we are looking at kind of simplifying and saying, yes, the focus is on the platform. The focus is on our star assessment kind of content businesses like ICAS and AAS, in a manner that we are also being supported by delivery services. So the simplification of our content business and saying that ICAS and AAS are the ones that we're going to focus on is also allowing us to make sure that from a leadership perspective, from an investment perspective, from a market perspective, we are being able to invest on these and ensure that we are providing that exceptional service the market deserves, that provides a long-term value creation for shareholders, for the business, and everyone involved. So these are just some very quick highlights on the content side of the business. Stu, I hand over to you.
Yeah, thank you. I'll just take a couple of seconds to run through the cash flow and the balance sheet. It won't take too long, just so we've got some time for questions at the end. Key takeout here, obviously very good positive net operating cash flow versus a sort of a negative cash flow last year. Obviously the changes we made in the first half to the headcount have really kind of helped us deliver a reduction in spend, but also through revenue growth as well, we've been able to deliver that net operating cash flow. And despite those sort of cuts and changes in the business, we were still able to spend the same amount of money on our capital projects, on our product development of 1.4, and leaving us with a sort of a very healthy cash balance of 10 million, which gives us a sort of a very good runway for growth from here on. So I think the takeout is that we're comfortably or well funded, and we don't have any need to raise further capital. And then from here into looking ahead into the second half, we expect that our balance will remain about the same. It does sort of fluctuate over the next few months, but we expect that we'll finish the year with a similar number in the bank, around about that $10 million. In terms of the balance sheet, again, pretty robust balance sheet. We don't have any debt. We've got a couple of $1 million of facility available to us as well if necessary, and we've got positive working capital. Probably won't go into too much of the detail here. I covered this in the previous market update we did, which is posted on our website if anyone wants to listen in around any of the specific movements. Unless there's questions here, we're happy to take them. But otherwise, I think I'd probably just wrap here and just say, look, I think it's been an interesting 6 months. Lots happened. I think we've sort of done a lot of groundwork and foundation setting now through what Sujata's done, and with AI and so on, that set us up for a really good second half and future years. I think commenting on sort of the share price performance, I think a lot of people have asked me what's happened, what's been going on over the last couple of years, and I think you could probably sum it up by saying there's been a bit of uncertainty. We had a leadership gap for a period of time, and then we sort of came in and did some new changes once Sujata joined, and maybe a bit of overhyping in previous years as well. But I think where we are now is in a very good position. We've got a pipeline slide later on that we can look at, but it's very large and it's grown substantially in versus previous years. So I think that gives us some really good confidence. It does need to keep growing. We accept that, and I think, but it gives us a lot of confidence where we are at this point in time. We've the cash in the bank, refresh strategy, new leadership, and really sort of bolstering our sales and marketing efforts through new hires and through the advisory committee as well that we haven't yet touched on. So I think we're in a really good space and ready to grow. Do we go through the? Do you want to touch on more of this, or I'm just conscious of time, Mark?
We've only got 5 minutes left, and we have got quite a few questions here, so I would like to tackle some of those. But maybe if you go back to that slide, Stuart, there is a question on 2 questions actually on pipeline. Sorry, that pipeline slide. Sorry, the one you were just tapping to. The one question is, how diversified is it, small versus large deals within there? And then the other question, sorry, let me just find it. Yeah. The stages that they're at, which I think this slide addresses, whether you're at preferred supplier stage, shortlist stage, maybe if, I don't know if Sujata, if you want to talk about it.
Yeah, no, thank you, Mark, and happy to answer the question. So essentially, I think what the slide demonstrates is at what stage each of our opportunities are in the pipeline. And this is just to acknowledge that the huge amount of the pipeline building work has begun in the current financial year, which is from middle of last year. So they are progressing fast. So, but at the same time, I think, they are at different stages. What we are looking at is moving as much as possible to the qualified stage and the conversion stage. It's quite a diversified range of organizations, whether it's government agencies, higher education, professional accreditation, and also in terms of geographical spread, it's quite closely aligned with our geographical focus as a business. So very much APAC and UK and the surround. So yes, I think, as I've acknowledged here, sales conversion takes typically 12 to 18 months. So given that, I think we are quite pleased with where the sales pipelines are progressing. And our objective as a business also is, try and see whether we can expedite and push everything as fast as possible where, without actually having to wait for 12 to 18 months where possible. But what we are pleased is actually the pipeline continues to be built. So which means that finally, when we reach a stage where many of these opportunities have been pushed to the qualified and conversion stage, at that point, we'll also have enough of them, in the differentiated selected stage. So we have the constant flow of deals landing on our desk and not the large gaps that we have at the moment.
Okay. Stuart, maybe one for you. Given the current revenue mix, what's the sustainable gross margin for solutions, the solution business, now that we're including the lower margin New South Wales selective test into there?
Yeah, good question. I think the best way to answer that is to explain that the solutions business or the platform business, it comprises 2 types of revenue: licensing, where we simply provide the platform, and customers pay us an annual license fee for that. Typically, that ranges between sort of 70 to 90% margin, gross margin, and that's sustainable. And then on the other side of the sort of revenue type, we have services, and this can vary in terms of how much service people or customers require, in terms of how much support they need around the event, how much delivery support or technical support, pre-work, development, all kinds of sort of ancillary services that we can provide, which is part of our point of differentiation and something that makes our clients very sticky. That services revenue can be quite low in margin, particularly if it's a pass through of particular costs, and it can range from sort of 30 to 50%. What we're in a situation of now is that this DOE deal is heavily services weighted. The Department of Education, very risk averse, has requested us to be very hands-on in the process, and we are running many test centres, arranging casual invigilation staff, venue hire, equipment hire, all these sort of events, even finding and subcontracting the content for the questions that go into the test. So this is a bit of an anomaly, and for that reason, that's why we've seen a reduction in the gross margin, particularly over the last sort of 12 months, as we've embedded this project for selective schools. So that's sort of a long answer. Short answer is, when you blend those two together, looking forward at the pipeline that we've got here and the type of customers and the type of deals we're looking at, I suspect that something around 60 to 65% GP is probably a sustainable gross margin on a blended basis when you take into account all the licensing and all the services that you'll see. And maybe if I just jump to the first question as well from Stella, there's a question around how much revenue we've booked to this selective high schools exam, which is a really good question, because last year we ran this test in paper-based form, and we delivered $4 million in the second half of revenue for this client. Nothing in the first half, $4 million in the second half. Fast forward to this year, and we've delivered $2 million in the first half for the digital version of this test, and we'll be delivering $8 million in the second half. So we've seen an incremental $2 million in the first half this year, and we'll see an incremental $4 million in the second half. So it's a worthy point to make, because it does point to a larger revenue growth in the second half for us.
Yeah, thanks, Shirley. I think it's what you guys were saying, the numbers out here, the underlying numbers, that 18% you were talking about, is kind of a bit more closer to the mark than what was, and this is a kind of a key example of that. Sujata, Stuart, we're just going to have to leave it there, unfortunately. We're just up on time. But yeah, apologies if we didn't get to all the questions. I know we didn't. Please do reach out to Stuart and Sujata. I'm sure they'll get back to you over email. And hopefully we can get you back on maybe a little later into the year, and you can give us an update, a further update on pipeline and all the new stuff happening with New South Wales Department of Education.
Absolutely. We'd love that, Mark. Thank you so much. And Stu and I are available. Any questions, reach us. We'll be very happy to answer anytime. But look forward to coming back again, Mark. Thank you for having us.
Thank you very much. And Stuart, if I could just ask you to stop sharing the Janison presentation. We will hand over to Michael Shirley from Veris, who's waiting patiently here with us. Michael, good morning.
Morning, Mark.
Michael, I can see the cover slide of your presentation now, so you can take it away when you're ready to start.
Great. Thanks very much, Mark. And I appreciate everyone joining us here today for an update on Veris. And I'm going to build on a few of the themes that we gave in our first half results briefing, which was a couple of weeks ago now. As we've consolidated the performance operational focus of our business, we've really been able to accelerate the transformative elements of our strategy. The transformation is essential for our sustained growth and performance in Veris, and we've evolved from our survey base to a more integrated professional services firm. Our differentiator has really been our digital capability and its application. And the essence of our digital strategy is about supporting our clients through digital solutions which empower their own transformation. We're building our digital advisory consulting services with a unique position in the market, and our spatial data core provides us a capability to deliver digital twin-based solutions and outcomes which are further enhanced through our bespoke AI solutions and analytics. As our industry really shifts to be further digitally enabled, we lead that transformation by unlocking digital innovation and providing values-based solutions. And Veris is making really strong progress towards our vision of being an integrated digital advisory consulting firm, and this first half has really shown the opportunity in our progress. I'd like to highlight some of these key achievements in the first half of the year, and importantly, we've been able to accelerate our transformation while still delivering a really strong rebound in profitability. A $1 million profit before tax is over a 200% increase from our prior comparable period. And this is a strong turnaround, and it really validates the restructuring and investment we've made in our business. Our margin also increased by over 200% from the prior comparable period, and delivering some of the outcomes from the operational efforts we've put in. Our revenue of $47 million is really quality revenue in the segments of the market we've targeted as our strategic priorities. We've set a strategy to build high margin, quality revenue in sectors of growth and strength, and the revenue, margin and profit we've delivered shows the strength of the strategy and the quality of our execution. The outlook remains really strong, and we've got a consistent, clear pipeline of work for the future. We've got a backlog of over $55 million, and that shows that future is stable and it's also growing. And we continue to show progress in the execution of our digital and spatial strategy. The revenue from that sector is 20% of our total revenue now and continues to grow. And off the base of this strong, profitable organic growth, we've now made the first of our recent acquisitions with the acquisition of Spatial Vision, and I'll touch on that in a moment. This is well within our articulated strategy and really accelerates the execution of our digital and spatial transformation as a business. So talk now about the first half and the financial results, and that really shows a strong progression in margin improvement over the last few years. We've focused the business, which has led to a slight decline in overall revenue, and this has always been part of the strategy. We've articulated that we will stay in areas of higher margin rather than competing for revenue which have minimal margin. Our EBIT, PBT have increased significantly in comparison to the prior comparable period, and this demonstrates our progress as a validation of our strategy execution. We're a cash-generating business at our operating level now, and our cash position at the end of December was $17.6 million. And that's a good indication of the rebuild positioning of our business, and we now have a really strong balance sheet and capital position. This gives us significant headroom to deliver on our strategy and our acquisitions going forward. As part of this focus on margin, we've continued to increase the scale of our projects and our clients. And this is shown through a greater than 25% decrease in project numbers with a really minimal impact on our revenue. The digital and spatial share of the business continues to grow, as I touched on, in excess of 20% of our revenue now and continuing to grow. And this H1 result really shows we're a growing, profitable business with progress in our digital transition, evidenced through the increased share of that revenue. We've got a strong balance sheet, we've got cash reserves, we're well positioned financially to execute on our strategy at pace. Veris has really been a journey of transformation. As COVID hit the business, we started on our strategy to rebuild the business, and the first steps were about saving the business through restructuring operations, focusing on areas of underperformance, and stabilising debt and cash management within our business. We've continued to invest in the strategic repositioning of Veris throughout this journey. The period of stabilisation was about restructuring the balance sheet, embedding operational efficiency, implementing strong capital management, for example, in our fleet management and our equipment and capital investment. From this stable base with a strong balance sheet, we've invested to grow and position the business for our transformation. This transformation has included investment in technology, in our talent, digital strategy, and building from this strong organic growth. And from this position of profitable growth, we, as I've outlined, have a strong cash position, robust balance sheet, and we're now making good progress in our transformation. The transformation is absolutely essential for Veris. We see that the execution of the digital strategy, leveraging our core spatial data, creates a differentiated business with high margin, high value. Acquisition is being used to accelerate our progress in that strategy on top of the internal organic elements of our approach. We're confident in the future because of the strategy, and we're showing that progress through our execution. Over the last couple of years, we really talked about our client program and the sectors in which we've chosen to focus. We've grown the share of revenue from a core group of strong key clients, and this has been an important element of our margin improvement plan. It's worth understanding the scale and the nature of the markets we've targeted and the opportunity this presents for Veris. All of our core markets show strong, ongoing compound annual growth, and the slowest growth opportunities still over 7.5%. Our strategy is aligned to strong growing markets, and the transport market, for example, continues to grow at over 9.5%, and our addressable market in this area is more than $200 million. In the property sector, we continue to be aligned to blue chip clients showing growth as the country addresses ongoing housing shortages, continued immigration. And we see this will be a really strong opportunity, particularly for us on the East Coast. The government market is significant and growing, and our addressable market is effectively $280 million. The Spatial Vision acquisition adds revenue and relationships right in this sector, which will provide a strong base from which to build. Our combination of water and energy focus that we have in the utilities and energy markets is a really new opportunity for Veris. I see these sectors continuing to grow over the next few years, and Veris will be able to add real scale in these markets. We've previously discussed our position in the defence sector also. The addressable market for our spatial services is significant, and we continue to grow in this area. Overall, you can see that we're aligned to the strong growth sectors in the market. All of these sectors have scale, and our clients are quality clients of scale across these sectors. And this is a real validation of that strategic client focus we've taken over the last few years. Over the years, we've continued to report on our backlog and pipeline also, and we've shown that the conversion of that pipeline to ongoing revenue. Despite the challenges we have here in Victoria, for example, we've been able to continue and maintain our combined pipeline, noting that the current pipeline currently excludes any consideration from spatial vision. Our secure backlog is still $55 million, and our unsecured targeted pipeline is in excess of $190 million. We've transitioned this pipeline mix to a stronger mix of higher margin, multidisciplinary, and digital and spatial future revenue. And the engineering survey opportunities remain, but they're a lesser proportion of our outlook, and only the opportunities of quality and margin remain a focus. Our mix of markets and geographies, our national resourcing model really allow us to maintain a strong outlook despite some challenges in different geographies like Victoria. And we're really confident in the outlook and the growth remains within our pipeline and what that presents. When we talk about our digital strategy execution, it's important to understand what we mean by that. It's not a generic digital strategy or a software sales approach. Our strategy is firmly based on the accurate spatial data within our environment. It's then about using that data, capability, and our relationships to expand the client value proposition. We're using AI and analytics to develop and enhance digital solutions which provide value for our clients. The aim is to build a digitally focused advisory business at a high margin with differentiated growth proposition. We see this allows us to develop then alternate parallel revenue streams with a focus on margin, not volume, and with our key clients and not a broad, low margin transactional approach. I'd just like to highlight a couple of examples where we've been able to use these digital solutions to deliver improved value for our clients. Recently, we won a role supporting Mirvac in the development of their Monarch Glen Master Plan community in Queensland. We've been able to come to this opportunity through our digital urbanism solution, which has taken us into the upfront planning and development work supporting Mirvac. The solution provides a visualization and modelling approach that is spatially accurate digital model of the planned urban environment. The approach brings in our reality capture skills of the team. It's an innovative offering that has disrupted the historical survey-led approach in this industry. The initial work is for the first 10% of the community, and this allows us the opportunity to continue to follow the long-term development with Mirvac throughout the project. We've also been able to provide survey and planning services at scale from this upfront work. In another example of disruption and digital innovation, we've worked with one of our key clients to support their delivery of a key energy transmission project. Instead of using traditional condition assessment approaches, which are manual and laborious, we've applied our roadside solution to this problem. We've been able to deliver route analysis, dilapidation assessment, detailed condition assessment, and a comprehensive GIS database. And this is being provided all through our digital portal within roadside, rather than hard copy or sending people data. It then allows subsequent temporal assessment and comparison of that data. And this unique mix between high precision reality capture, innovative platform delivery, and detailed spatial analytics means that roadside is an innovative solution in a very traditional market, ripe for disruption. And then thirdly, in a totally different solution, Veris have been able to support a government agency delivering flood mapping and data insights. We've been able to bring together a mix of reality capture techniques, a series of high-level spatial analytics to deliver this outcome. We're in a position to provide a comprehensive solution that supports government in critical infrastructure decision-making. All three of these examples show how the different Veris solutions apply across different markets, from property to infrastructure to government. This provides scale in our addressable market. And we've also been able to show how our solutions provide innovative avenues to market and different avenues of revenue growth for Veris. We've now been able to complete the acquisition of Spatial Vision. And Spatial Vision have a fantastic brand in the market, 25-year history in delivering spatial services to the government and private sectors. Their core skills align strongly with Veris and our strategic future. They've got a depth in GIS, spatial analytics, strong enterprise GIS capabilities, a unique application development team, which is focused on spatial platforms. Their capabilities and clients are a really strong fit with the Veris strategy. The combined skill base aligns to the core growth in our digital and spatial strategy. The government client relationship strength that Spatial Vision brings mirrors our own growth into government clients we've been building over the last few years. Finally, they bring scale. 40 staff, $9 billion of revenue is a size which can both be easily integrated while also providing critical mass that's additive in an acquisition. In addition to the strengths they've brought to Veris, there are strong synergies that provide for an accretive acquisition aligned with our strategy. The Spatial Vision team can be easily integrated into our existing operational business, and this is aligned to their current operating form, which means it's easily accommodated, minimising disruption and costs through that process. Financially, this provides significant synergies. We can add the core of Spatial Vision while having a net decrease in operating costs across the two businesses. The technical skills that Spatial Vision bring add new capabilities in enterprise GIS and integrated skills in the spatial and GIS analytics. The software and platform capabilities of Spatial Vision's Lapis business add a new strong market focus for Veris. It aligns with our digital solutions development capability. It's a new client-facing revenue as well. Overall, we add depth and capability, new skills, additional client relationships, while delivering synergies through operational efficiencies, make it a good additive acquisition. I'd just like to highlight a few key points from our first half as I wrap up. The first half has shown that we're clearly delivering on our digital strategy. The mix of revenue shows that our digital and spatial revenue exceeding 20%, continuing to grow well from the base of 3 to 5% a number of years ago. This mix of revenue continues to move to stronger margins. Our pipeline is significant in focused areas with a good secure backlog in excess of $55 million, showing the business has got an outlook of sustained future growth. We've been able to transition our business further to our digital advisory skill sets, and our cash balance has grown, and we've got a strong balance sheet, which both provides stability and also opportunity for the business. From the base of this organically growing profitable business, we've now acquired Spatial Vision, which is delivering on our commitment that we've articulated to accelerate strategic execution through targeted acquisitions. Our first half shows that the transformation of the business is now well progressed and creating new opportunities for the business. We've made significant progress transforming to a growing, profitable business whilst delivering on our digital future. Our digital transformation provides a compelling differentiator in the market, and we see great progress, and there's more of that to come. We're well positioned financially and operationally to capture the opportunity through our strategy. Outlook is positive. We see our path on our strategic journey, which is delivering strong and growing returns for the business. So, Mark, I thank everyone for their interest today. I'm happy to take any other questions along the way.
Yeah, we had a few come in there, Michael, while you were going through the deck. The first one, traditionally consulting businesses, they operate on a kind of 8 to 10% profit before tax margin. And the question is, why is Veris at a 2% profit before tax margin? Maybe just talk on, whether that's to do with revenue mix, the digital business coming in there, investments that you've made upfront that, are only going to come through later. Maybe just give us a sense of, where margins are and where they're going.
Yeah, look, it's a good question addressing this transformation that I've articulated today and sort of previously, is that if you look at Veris a number of years ago, it was a long way from being that consulting or advisory style business that the question addresses. That is the position we're moving the business to. We're doing it while cleaning up the balance sheet, investing in the digital future, because we see that provides further high margin revenue over time, and at the same time transitioning to that high margin consulting business. Traditionally, large elements of the survey sector are very much a volume-based commodity, low margin business. You've seen that in the past. We talked about that last year and previously when we've been with you, Mark, that we're really working to exit that whilst maintaining revenue and cash growth in the business. So we're right in the position of that transformation at the moment, and we continue to invest pretty heavily in both the transformation and the digital positioning, because that's what's going to give us sustained long-term growth and also returns for shareholders over time.
And then another one, I don't know if you have given guidance, but the question is around expectations for full year positive impact, or have you? I don't know if you. This is a cut down deck. I don't know if you mentioned that in the results deck.
No, we haven't formally mentioned that. Look, we've said that we're confident that the positive impact will be the outcome for this year, and we'll continue to grow it over the next year. We haven't given guidance into what next year looks like, but we've also made the commitment that returning the business to profitability, which we've done over the last couple of years, we're not stepping back for that, and we'll continue to grow it over time.
And then just a question on, as this change has gone on and restructuring has happened, is there restructuring costs within those numbers or in the prior comparative periods? I'm just trying to get a sense of, what the underlying is or what, we're comparing to in the prior period.
We haven't, the result we've released has been, the off the bat result, we haven't moved anything to restructuring or other elements in this year. So we're trying to make a direct comparison of what the business is doing, accommodating any of our restructuring, any of our investment, all of those things to give a very clean result for the half.
Okay, perfect. I mean, we've had, I don't know if you want to call them competitors to you, Michael, but I'm sure you know them from around the industry. We've had RemSense on here last week. We've had Ian Olsen from Pontera on here before. We've had the guys from Aerometrics in Adelaide on here before. But there does seem to be a huge drive in all of these businesses, and I appreciate they operate in kind of different verticals, different sectors, or doing slightly different things, but of digitizing assets and utilizing it for digital twins, or just getting a handle on their work programs or whatever. I'm kind of wondering, why is there such an uptake in these digital solutions across the industry? Is it just that the technology with AI advancements and stuff in the last kind of 2 or 3 years has kind of made it so, and people are just embracing it now and saying, we can do this in a much more efficient technological digital way than what we have kind of done historically?
Look, I think there's a few drivers in that, Mark. One is that the advances in technology means that we can provide more insights on assets than we've been able to do in the past, and we're able to do it more rapidly than we've been able to do in the past. I think with the investment in infrastructure, there's also a real driver at the moment to get more efficiency out of that. We can't just keep building new things. So we have to be very efficient in what we're building and maximizing that. And we're really targeted that whole of life at an asset scale, because for us and for the industry, that delivers value for both our clients and the community. So the piece of being able to get better value out of your assets, better value in your investment in those assets, longevity out of them through understanding from these spatial insights is a real value capture mechanism. We're able now to do it at scale. You look at our digital and spatial revenue in excess of $25 million and probably more by the end of the year. That's a scale that many others don't have, and it gives us that national position to work with the big clients really at the high end of the margin space. So that's why we're targeting that growth.
Yeah, maybe just if we talk about margins, I know in the result there, you had GP margin, EBIT margin, profit before tax margin. I mean, if we had to pick one of those three, what is the key focus for management? Is it getting the GP margin up and everything else kind of flows down, or are you really targeting, the profit before tax margin? If people are looking for the standout number in results to kind of track the progress, which one would you direct them to?
Look, we'd really send everyone to our NPAT margin. I think our history, prior to us, our predecessors, there's a lot of discussion about EBITDA and other things. Ultimately, the only thing that's going to deliver sustained returns for our shareholders will be an NPAT margin that lets us be cash generating, invest that in elements of our strategy, and at the same time deliver dividends and returns to our shareholders. So we've been very clear to say that as a business, we will invest in this transition at the same time as starting to give our shareholders returns. And we've done that over the last couple of years, and we'll do that. And so that NPAT is the only way we demonstrate credibility in that space. We've come out and said, got a business that years ago was losing money. It's now making money. We want it to be in a position where our shareholders get a return on that while we continue to invest in the transformation. So we haven't gone away and lost money for a couple of years. We've stayed at scale. We've built the profitability and invested really heavily in that strategic execution, which I think over the next couple of years really shows the uptick that's coming. And you've started seeing that in the first half of this year. And we are now investing in pace because we're seeing that return. But ultimately, if we're a loss-making business, no one will believe us. So we really only talk about NPAT, and we deliver on that because that is where our shareholders are seeing that return.
And then finally, maybe the last one, Michael, I know you've got one recent acquisition, which is been busy integrated, and there's a kind of a large cash balance there that you can use for future acquisitions. In terms of those potential future acquisitions, are they more a focus of they can bring new tech that you can roll out across the Veris network, or are they more focused on they can get us into more customers within the verticals that we've identified? Maybe it's somebody in the government sector, but in Queensland as opposed to down in Victoria. Maybe just give us a sense of where those future acquisitions might slot into the overall Veris growth story.
Yeah, good question, Mark. Look, I think the easy way to answer is we're not trying to add more survey to the business. We think we've got that mix about right. The areas we're looking at are things that are strongly aligned to our digital and spatial strategy execution, and spatial vision is an example of that, where we can accelerate that digital and spatial execution, build out our own solutions, do that work, add scale into that part of the business. So that would be one element. Second element is the area that we're talking about, which are these aligned services that build out that broader base consulting and advisory business. So things that draw off that spatial data, and there's areas we have within our business that are consulting advisory in terms of planning, project management, engineering, that would build off that core base of our strategy. We're looking into those areas. And thirdly, we're looking at sort of mergers or acquisitions that help us add material scale, because that helps us step up in our terms of our presence, either scale or geographically. Now, the first two components are things that are easier to address and are the shorter term bit that will build scale off the organic base. I think the other thing we're saying is we're not looking to be a technology incubator for others who've got a pretty cool idea but are losing money along the way. So we're not picking up emerging technologies that are going to be 3 years from being profitable. We're picking things that we can bring into our current model, make them accretive, deliver on them, and there's good opportunities out there in the market at the moment. So that's why we're being pretty aggressive.
Okay, perfect. Michael, we leave it there. Thank you very much for joining us. We were finished actually bang on time, so thank you very much. And
Thanks, Mark.
over to our final presenter of the morning, Stephen Lydeamore, coming back to give us an update on all things Immuron. Morning, Stephen.
Good morning. How are you?
I'm very well. We're moving from one part of Melbourne to the other. If you want to just bring up your deck, Stephen, I will let you know when it's. Yeah, I can see the cover slide now, Stephen. You can take it away whenever you're ready.
Okay. I need to somehow get it back on my screen. Anyway, it doesn't matter. That's fine. Yeah, so thanks everybody for taking the time to listen to me today. It's been a few months since I've last presented on Coffee Microcaps, and we've got some great updates for you, so let's get straight into it. All right, is that working? Yes, so just skip through the safe harbour statement. This presentation does include some unaudited numbers. So quickly, for those that aren't familiar with Immuron, so we're a Melbourne-based biotech company. A little bit unusual in that we have a product on the market, Travelan, which I'll talk about, generating ever-increasing revenue, but also a substantial portfolio of clinical assets. We have a platform technology where we develop proprietary vaccines, and we vaccinate cows, dairy cows, and extract the colostrum containing polyclonal antibodies, which is essentially the drug substance that goes into each product. And we have Travelan itself in clinical trials. We have a product for Clostridial difficile infection, or C. diff, or CDI for short. And we've recently collaborated with the Monash University on a new product for vancomycin-resistant enterococci, which is a big problem in Australian hospitals as well as around the world, an antimicrobial resistance issue. So some of the updates that we have here from the last one that I presented. So We've now submitted the phase 2 study that we completed for Travelan with the FDA. The next steps for that is to request an end of phase 2 meeting where we'll discuss and get approval for a clinical protocol for moving into phase 3. So we're targeting to do that in the next 6 months or so. And with IMM 529, which is the C. diff asset, we have filed pre-IND with the FDA and got really good feedback. And so we're preparing an IND that's an investigational new drug application, planning on filing it around June of this year, so near-term milestone, with a view to starting phase 2 clinical trials with that product in the second half of this calendar year. So that's quite exciting there as well. You may have seen recently in the news that we've entered into a new agreement with a Swedish company, Calmino Group AB, for exclusive distribution rights for a product called Pro-IBS. That's for irritable bowel syndrome. We'll be launching that either somewhere around late this calendar year or in the first quarter of next calendar year. Timing's dependent on getting that product on the TGA, manufacturing launch inventory, and having discussions with pharmacy groups and getting it listed. So that's exciting for us. So I've had on my slide the last few times I've presented on Coffee Microcaps about looking for new products, and finally been glad to say that we have one, but we are continuing to look for more. We've got a really good relationship with Australian pharmacies. So we're essentially stocked in all pharmacy banners across in Australia. That gives us some confidence we'll be able to successfully launch this new product, Pro-IBS. And you can see the sales update here. And so every time I talk now about sales with Travelan, it's striking new records. So we've just closed out the first half of our financial year ending December 2024 with revenue of 4 million, and last year for the full year we did 4.9. So you can see the growth rate is significant, and we expect that to continue. Here's an overview of the company. The technology platform I mentioned, the R&D I've mentioned, the global footprint. So we sell not only in Australia, but we sell Travelan in the US and Canada as well. The product, Travelan, I've already mentioned. We have one other product that we currently sell in Australia, Protectin. That's not in the pharmacy channel, but in the food store channel. It's a product that's good for gut health, but also for liver health. And there's an outline of the new product, Pro-IBS for irritable bowel syndrome. So just some quick facts about traveller's diarrhea. So why is this market interesting? So the CDC, so the Centre for Disease Control in the US, says that anywhere between 30 and 70% of the time you might get traveller's diarrhea. It will ruin your holiday, and there are no drugs approved for prevention of traveller's diarrhea. We're aiming to be the first through that clinical program on Travelan that I mentioned. But in the meantime, our product is available over the counter in Australia, Canada, and the US market with strong clinical evidence. So we have clinical evidence in studies that we've done showing up to 90% effectiveness in preventing traveller's diarrhea. So great product if you've never tried it. If you're travelling to Bali or somewhere like that, I do recommend that you give it a go. You can see on this chart how prevalent traveller's diarrhea is. So colour chart there, green. Australia, we're pretty safe, as is US and Canada. But the good thing is people from those countries travel to other countries on whether it's for vacation or for work, which do have a high risk of traveller's diarrhea. Red's obviously the worst, and yellow sort of medium risk. And places like Bali are in that red area. So a significant part of the globe is at risk of traveller's diarrhea, and they're the target markets for people travelling to those regions. So this is a $1 billion opportunity, and we've just started this process of starting to penetrate it. What we really need to do is convert the market from products that treat traveller's diarrhea after you get it to taking the opportunity to prevent it before you get it. And so at the moment, people might take with them, a traveller's kit containing loperamide, with brand names like Imodium or Gastrostop, oral rehydration salts, and there's quite a few different brands of those in case you get it. And yes, they help relieve travellers' diarrhoea if you get it, but it doesn't stop you from getting it in the first place, and it certainly doesn't stop you from getting sick and ruining your holiday. So there's a good opportunity to take Travelan, and you can see here what our product offers you, which is it binds and neutralises to prevent travellers' diarrhoea, and that's our strong point of differentiation from other colostrum products that are on the market. This chart, I really like it, showing our sales growth. So it's shown in colour form here: green for Australia, blue for the US, and red for Canada. So Canada was a recent launch. It's a market not unlike Australia, that's a pharmacy sales market. We've launched into many of the large pharmacy banner groups in Canada, as well as grocery. So the largest pharmacy banner group in Canada is Shoppers Drug Mart. It's owned by one of the largest grocery retailers, Loblaws, and we're in both of those. So we expect that growth to continue. And pleasingly, our revenue contribution from North America, even though Australian sales continue to increase, it's growing at even a greater percentage in the North American market, further diversifying our growth capability. And of course, Canada is slightly larger than Australia on a population basis. US is much, much larger, so a big opportunity there going forward. This chart shows you while we've been having this success, we've been expanding distribution sites. You can see in Australia a large number of pharmacy banner groups that we're in, and in Canada, not all of them yet, but quite a substantial list of those. So large ones like Shoppers Drug Mart, Loblaws, Rexall, Sobeys is another grocery channel. In the US market, we've been having great success with Amazon, and we've had during the current financial year record months of sales, and also a record half year, and so that bodes well going forward as well. So quickly jumping back to the R&D side of our business, so we have a strong pipeline here. So Travelan, there's 2 trials in play. The phase 2 one I mentioned already, so we've completed that one and submitted the clinical study report to the FDA. Next steps is that end of phase 2 meeting with the FDA with a plan to move into phase 3. But in the meantime, we have been running in collaboration with the Uniformed Services University. This is a military university, a very large study in 866, and the subjects in this study are not civilians. These are military personnel travelling on deployment to high-risk regions. Think back to that globe chart, some of those red regions that I showed before. This is a large trial showing that in a real-world setting, can Travelan prevent, placebo-controlled trial, prevent travellers' diarrhoea in these military personnel. And the good news is that's now 100% recruited. We're waiting on deployment of the final military personnel before they can complete dosing and get the top-line clinical study results. So at the moment, best estimate is July, but it is depending on when those troops are deployed, so we can complete the final dosing in that study. Clostridioides difficile, I did mention, that's IMM 529. We've had successful feedback from the FDA on pre-IND filing. Preparing the investigational new drug filing. We hope to have that submitted around June with a view to approval and moving into phase 2 in the second half of this calendar year. And lastly, that vancomycin-resistant enterococci. This is a preclinical program in collaboration with Monash University using our technology platform. Good news is, though, we will have near-term milestones on that. Somewhere around July, we should have the results of that preclinical study. And some of the details around, I'll let you read these at your leisure, but IMM 529, we've had really good preclinical studies showing the ability to prevent, to reduce recurrence. So with Clostridioides difficile infection, ironically, it's both treated with and caused by antibiotics. And a significant percentage of people that are treated with antibiotics, when they get recurrence, and then they get recurrence again. So big problem, big antimicrobial resistance problem, and a non-antibiotic product like ours is sorely needed. So we're quite excited to look forward to moving into phase 2 on that program. These are some scientific references showing you that while Travelan is sold over the counter, it's not a product which is devoid of clinical and scientific evidence. And we have that clinical study that I mentioned before. It's on here. It's the first one. It's the Otto study showing up to 90% protection against travellers' diarrhea. But we've done an extensive amount of work with US Department of Defence funding showing broad spectrum activity, not just against enterotoxigenic E. coli, which is what the vaccine that Travelan's been developed with, but also against things like salmonella, cholera, some forms of Shigella. Has broad spectrum. It's been tested in the Walter Reed Army Research Institute's labs and in animal studies in Thailand, showing broad activity in up to 180 different pathogens. And that's why we have good confidence in that Uniformed Services University trial, and good confidence leading into the planned phase 3 studies for Travelan. And those preclinical study results I showed on the previous slide for IMM 529 and C. diff, there's a published paper here that you can read giving more information regarding that. And I'm going to pause there and open it up for any questions that you may have.
Cheers, thanks, Steve. Maybe I'll kick off the questions here. And look, I don't think we can talk to you and you know what's happening in the US/Canada trade wars. You know, maybe just give us a sense of possible impacts that might come your way, depending on whatever comes out in the wash. It changes daily, and I think you must be glued to CNBC every night to see what the latest is. But you know, what are you doing, you know, maybe in the background to mitigate anything that might come out in terms of, you know, manufacturing, distribution, transferring stuff from Canada to the US, US to Canada? Maybe just give us a sense there.
Yeah, it's been quite topical in our industry in particular at the moment, especially since the Trump government's been cutting back resources within groups in the FDA and the NIH, and also being putting a pause on grant funding and what have you. In terms of impact on Immuron, in the short term, on the sales side, we've got substantial inventory sitting in the US, so the potential for tariffs being brought in is not going to impact us for the next 12 months or so, but it could. So if they do introduce tariffs, and you've heard potential 10% tariffs being brought in across the board. If they do that, then likely that would impact us as well. Hasn't really impacted Canada at all, but clearly that country's hurting from the tariffs that the Trump administration has brought in against that particular country. Probably the biggest concern for us at the moment on the Trump administration is this review of grants and pausing of grants, because we have been planning, and we've been working with our partners, so the Uniformed Services University and other US Department of Defence groups that we've got funding from in the past. Just to put in perspective for viewers that aren't aware, US Department of Defence has funded a significant proportion of all of the Travelan preclinical and clinical work that we've done over the last a few years, including the recent phase 2 study. They funded most of that. And as we're moving into phase 3, we will require 2 phase 3 trials, and one of those, ideally, we would do in a military population in collaboration with the Uniformed Services University, which we will be seeking grant funding for. The other one will be done in a civilian population. We'll seek a grant funding for that as well. But we're planning to have to fund that ourselves if necessary. But even the USU grant funding there's a question mark over all grant funding in the US at the moment. So that's probably our biggest concern out of the all of the activities going on in the US at the moment.
Yeah, but as we sit here today, Steve, nothing has been cut. The programs of work are continuing on as
Absolutely. Yeah, so the Uniformed Services University trial that I mentioned, this is a large trial, quite an expensive one. It's being run by the Uniformed Services University under funding that they have already been granted, and yes, that's continuing, so there's no risk to that. That's 100% recruited, so there's only a small portion of subjects left to dose in that anyway, but there's been no hint of any concern about funding being pulled from that and that trial not being able to finish. So yeah, no immediate concerns on funding.
Okay. I do want to just touch on the new distribution agreement for Pro IBS. In terms of that product, is it going to be a prescribed product from doctors, who are treating patients, or will it be a over-the-counter product that they can request from a pharmacist? Maybe just give us a sense of the go-to-market strategy for Pro IBS.
Yeah, so the product's sold as a medical device, a CE mark medical device. You're from Europe, you'd be familiar with those. It's a bit unusual in that when you think of medical devices, you normally think of things that are device-like, but this is actually powders in a stick sachet that you mix with water and drink orally. In Australia, we will be selling it not as a prescription medicine and not even behind the counter in pharmacy. It will be out on the shelf over the counter product. And so irritable bowel syndrome, big issue. I mean, doctor diagnosed IBS is depending on which definition you use, and there's like Rome 3, Rome 4. Rome 4 is maybe 5% of the population. Rome 3, anywhere up to 15%. But people with IBS type symptoms, probably 1/3 of the population at some point have a gut related issue that is IBS like, and so that's the target market for that product. So it doesn't matter whether it's you're having issues with diarrhea or constipation or bloating or abdominal pain. This product's been designed and it has clinical studies showing it has activity against all of those things. So yeah, front of counter, over the counter product. We're going to be targeting a retail pharmacy only, not grocery launch for this product.
Okay. And maybe just if we stick to product sales for a second, I do want to touch on the very strong result in travel and sales and stuff. Particularly, I want to get a sense of you had the chart there with Australia revenue, US revenue, Canadian. I mean, there was a big tick up in the Australian revenue. Is that more banners, getting more shelf space in new players, or what? I know all three markets were good, but Australia was coming off a kind of a bigger base and had like a very strong result. What kind of drove that Australian result?
Yeah, so in October, this was pre-set. Wholesalers, we sell to wholesalers, and wholesalers sell to the pharmacies. And our sales are recognised at the time we sell to a wholesaler. So in October, we sold a lot of product into wholesale ahead of the big travel season around the Christmas New Year period, and that would ordinarily be a big sales time, but it was even bigger because I think last time I mentioned we were largely reliant on Chemist Warehouse, which is our largest customer, but we sold in many other pharmacy groups, but we didn't have core listings with the other major pharmacy groups. And so we do have that now. So we've entered into agreements with Terry White Chemists and the other banner groups that I showed there. And we were sold in some Terry White Chemist stores, but by doing a corporate deal, you get in their planograms, you get into the majority of their stores, you get into their catalogs, you get into all of their promotional cycles. And we've been working with them, and products been in catalogs. We've been doing in-store training and promotions, and really growing our presence in the Australian pharmacy market. And wholesalers, knowing this, have brought in a whole lot of product in October, and we had a great uptake. Now, if you look at IQVIA sales, which are sales ex pharmacy, not the sales that we make into wholesale, we became the number one SKU in our digestive health category that we monitor. So even more than the largest SKU of gastrostop and Imodium. So yeah, things are going really, really well in retail pharmacy, and we hope that I shouldn't say hope. Hope's not a strategy. We're planning for that to continue from the ever increasing promotional spend and effort that we put behind the product.
And then can we quickly just touch on the other two markets? The US, Amazon has been a big focus for you, and it's done like really well. Walmart now, but is there a plan, to expand into the pharmacy market there? Get into like CVS or somebody like that, or obviously Walmart, huge channel, Amazon, huge channel. There's kind of enough growth there without trying to tackle into new things. And then in Canada, is it a similar thing? There's more banners to get into, more obviously smaller than the US, so lends itself more to replicating the setup that you have in Australia.
Yeah, Canada does lend itself to replicating what we do in Australia, and yes, you're right. So if you look at the banner groups that we have in Canada, we've got some good ones, but there's still a lot more to get. So on the Atlantic coast, you've got Jonker 2, which is a large player, and a number of other large banner groups. So we have to wait for category review cycles. But the plan is over the next 6 to 12 months or so, we'll get the opportunity to get into those, and that will be like Australia. When you add new banner groups, you get another wholesaler buy-in, and then it's up to us to get the promotional spend right to make sure that the product is bought and sold to consumers out of Canadian pharmacies and grocery. So we're looking to get into more grocery banner groups as well. In the US, we have a longer term plan to get into pharmacy, but I don't know if you read recently, Amazon overtook Walmart as the largest US retailer. Both of those are larger than the pharmacy channel market for products of this type. And the pharmacy channel in the US is struggling significantly at the moment. So we've had one banner group go into administration. Another one of them's being in play with the private equity. They're not doing so well. We're sort of waiting until we have that sort of brand recognition of Travelan before we enter into that market, because there's a high cost of entry. You can get in easily enough. You sign agreements, but that comes with very, very large listing fees and a very, very large promotion, commitment to a promotional spend. So we're not quite there yet, but we will. So maybe in probably closer to 12 months' time, we'll have another look at doing that, and probably wouldn't be CVS in the first instance. It's probably going to be pharmacy banner groups, which are more adjacent to that Caribbean and Mexican travel pattern of Americans.
Yeah. And across the three markets, are margins broadly the same, or is Australia more profitable than the other two? Just give us a sense of where margins fall in all those markets, and how that could impact if one grows rapidly over the other two.
Yeah, so Australia and Canada, similar margins. US, the margin's actually a little bit higher in the US, but the gross margin's higher in the US, but because we're spending to get that brand recognition. We're spending more as a percentage of sales on the marketing and promotional spend in the US. So net margins in the US are lower than Australia, as are Canada, because it's a less established market. But in terms of gross margin, US is the highest, followed by Canada, followed by Australia. But net margin, it would be Australia would be the highest net margin market at the moment. Less percentage spend on marketing compared to sales.
Yeah, more established brand. In terms of, I know when you've been on here before, you've touched on, the UK is a market for travel, and you'd like to, do a push into. Maybe just a quick update on your thoughts on moving there, or what has been happening in the UK market.
Yes, we've done all the research that we need to do to determine what we need to do there from a regulatory point of view, from a distribution point of view. Before we launch there, we need to just make sure that we get our supply chain planning set up. Last thing you want to do is end up launching in a market and then failing to supply on a timely basis. So we need to get our forecast right, our replenishment right, and our manufacturing plans. There's unfortunately long lead times in planning for manufacturing. So once we've got all that lined up, the UK would be the first European market we'd be looking to enter.
Or you're not expecting that, let's say in calendar year 25, by the time all of those
not calendar year 25, but 26 more likely. And it's interesting. As an Amazon market, the US is the largest, followed by Germany, and closely followed by the UK. So the UK is the third largest Amazon market. And you might say, why UK and not Germany? It's just we have all of our existing marketing and promotional material in English. So it's just easier to move into the UK market first. And once we've been successful there, then be pretty quick to move into the German market after that.
Yeah. And it's also EU versus UK these days as well.
Yes, that's
a final one on the the 800 military person study. Just remind us again when you said July for the top line numbers, but after that, when will the kind of full stuff be out? What's the next milestone after that, where we're seeing something in a peer-reviewed journal or something like that?
To get into a journal that happens even after the full clinical study report. The quickest you'd ever see someone do it is in 3 months. It's more likely a 6-month timeline for the university to do that after that top line data. And once you have the clinical study report, then you submit it for peer review. After that, so it takes quite a while before we get into a peer reviewed journal. But that's not to say that there are ways of getting the information out there sooner than that. This study is really important for us because, let's say, the CDC I mentioned before, if you go on there and you see, this is what doctors look at the CDC. They also look at the International Society for Travel Medicine as guidelines on what to recommend for prevention of traveller's diarrhea. Both of them at the moment basically talk about hygiene factors. So drink clean water, be careful what you eat, wash your hands, things like that. As I mentioned, there's no drug approved for prevention of traveller's diarrhea. And in the CDC guideline, it does mention, it's not by trade name, but it does mention colostrum. And what it says in the moment there is that, I can't remember the exact words, but basically it's saying that there is some evidence, but not sufficient evidence across all pathogen types to recommend it as a preventative for traveller's diarrhea. That's because that study that I mentioned before, much like the phase 2 study we just completed, was a challenge study. So in a challenge study, you actually give healthy subjects a large dose of bacteria to give them traveller's diarrhea. And they're the studies that we've done to show that it prevents traveller's diarrhea. And we used enterotoxigenic E. coli, which is the primary pathogen causing traveller's diarrhea, but not the only one. Now, we know from that research that was done by the US Army showing it has cross-reactivity against things like Salmonella, Vibrio, cholera, Shigella, etc., which are some of the other pathogens that cause traveller's diarrhea. But what we don't have is a placebo-controlled human study showing that it works against them. And that's what this Uniform Services University study will give us. So even ahead of FDA approval, if we get a positive result on that study, there's a good chance that we'll be able to get into some of those guidelines, and that will mean it opens up a huge part of the market in the US that we're not in. So for viewers that have heard me speak before, you'll be aware that in the US, unlike Australia and Canada, we don't have on-label claims for prevention of travellers' diarrhoea, and we're limited in what we can say in sales, marketing, and promotion. But with a study like that, we will be able to do that. And so if you think of the total market for travellers' diarrhoea from a preventative point of view, people that go on one of these trips with 50% of them, based on research, go and see a healthcare practitioner. We're not in that 50% of the market at the moment because we don't have label claims. Of the other 50% of the market, 30% of people just run the gauntlet and they'll go on holiday and they'll risk whether they get travellers' diarrhoea or not. So we're at the moment competing in 20% of that market where people go out there and seek products to prevent. And so, they can take our product. Some of them, try things like probiotics or charcoal or things that don't work, but things that they try. We're in that 20% segment at the moment. If we get a strong result from the Uniform Services University study, it opens up that whole market to us.
Okay, perfect. I just wanted to get the other dates and endpoints. So it's July, August for the top line, and then we say maybe this time next year the full clinical study report.
Yes, exactly. Yeah, so a lot of near-term milestones coming up. So IND filing for IMM 529 around June. Got the USU study somewhere around July, August. We've got the end of phase 2 meeting with the FDA probably around the middle of the year as well for the Traveland phase 2 moving into phase 3 study. So a lot of good milestones coming up, and also not forgetting the vancomycin-resistant enterococci preclinical results around July as well. So not too far now for a lot of milestones.
Yeah, and I mean, you're pretty good on giving Traveland sales updates as well, which
Yeah, we'll do that every quarter, and I like sounding like a broken record saying yet another record sales period, but that's a good problem to have.
Yeah, exactly. All right, Steve, listen, we've gone slightly over time, more than slightly, sorry, 5 minutes over time. We'll leave it there. Thank you very much for joining us once again. And I think let's touch base maybe in September time because after the full year result, because there's a lot going to happen there in that kind of June, July, August period. So I think it'd be good to touch base maybe end of August, early September.
Absolutely. Very good. Well, thanks for your time again, Mark, and Coffee Microcap viewers. So please feel free to contact me if you have any questions.
And thanks, Steve. And we will leave it there for today. And I wish everybody a good rest of their Friday and a good weekend. Thank you.